Siegel Rogers Casey would like to welcome you to today's webinar presentation, Investment Synopsis, Third Quarter Capital Market Review webinar. Now I would like to introduce our speakers. First, we have Hillary Wick. She is the Vice President of Alpha Research. We have Donna Rosequist, Director, Alpha Research, and Namisha Patel, Associate Director of Alpha Research. And now I'll turn the call over to Namisha.
Thanks, and good afternoon, everyone. Welcome to our third quarter synopsis review. Kicking it off with some macro indicators of the quarter, this chart highlights annualized GDP growth along with the year-over-year rolling percentage change in GDP growth. During the third quarter, GDP in the U.S. grew at an annualized rate of 2%, which is up approximately 1.3% in Q2 and higher than what economists expected. You can see from the chart that this is the 13th quarter of growth, though revisions to this number will be released on November 29th. Most of Q3's growth was attributed to accelerated consumption, increased government spending, and a downturn in imports. After experiencing negative growth in Q2, durable goods increased by 8.5% in Q3. And the rise in government spending was primarily driven by defense spending, which increased from minus 0.2% in Q2 to 13% in Q3. Next, we'll take a look at CPI. The headline CPI index was up 0.6% at the end of Q3 and advanced 2% on a year-over-year basis. The main driver of this was the energy index, which after falling 0.3% in July, the index rose 5.6% in August and another 4.5% in September. Fuel, motor oil, and gasoline prices all rose considerably during Q3. And since Q3 2011, food and energy prices have risen 1.6% and 2.4% respectively. Core CPI, which excludes both food and energy prices and is shown by the green line there, rose 0.1% in September, which brings the year-over-year core CPI number to 2%. This is in line with what the Fed targeted. Large contributors to this included medical care services and medical care commodities, which increased 4.4% and 3.3% respectively due to strong demand throughout the quarter. This growth, as I stated, is in line with the Fed's inflation target, and the Fed does acknowledge that inflation has moderated and describes it currently as stable. Next, we'll take a look at global monetary policy, in particularly the U.S., Europe, and Japan. This graph shows the target rates in each of these three regions. Starting with the U.S., the FOMC maintained its low target rate of 0 to 0.25%, and it is likely to do so through mid-2015. In September, the Fed announced their third round of quantitative easing, also known as QE3, intended to improve current economic conditions in the labor market. The open-ended plan will purchase about $40 billion a month in additional agency mortgage-backed securities, and the Fed also plans to maintain its existing policy of reinvesting the principal payments from its securities holdings. There wasn't a change to its June announcement to extend Operation Twist to the end of 2012. And combined, these policies we anticipate will increase the FOMC's holdings of longer-term securities by about $85 billion per month through the end of the year. When we turn to Europe, the ECB cut its target rate by 25 basis points in July to 0.75% and maintained this level throughout the remainder of Q3. In early September, the ECB announced a potentially unlimited bond purchasing program that would lower the borrowing costs for struggling Eurozone countries with a stipulation that the purchases would be tied explicitly to reform measures. When we move to Japan, not much has changed there. They've continued their low interest rate policy, maintaining their rates at close to 0 to 0.1%, and continued this quantitative easing trend that we saw throughout the quarter. During Q3, the Bank of Japan extended its asset purchase program through December of 2013 and increased its total quantitative easing by about 10 trillion yen to 80 trillion yen, or about $1 trillion. This is in an effort to rejuvenate the Japanese economy.